Welcome to the weekly update. This is being presented Sunday, February 20th, where I'll go over the action in the past week and then see how things look for the week of February 22nd through the 25th. And we were down pretty much overall for most of the week, but as I go through some of the longer term charts, and what I'm trying to do is just show some charts that I don't usually show in the daily videos. I not only make this weekly video, I also make a video each day where I provide analysis and commentary about what I see happening in the markets. So we'll look at some different charts. I'll give you a little bit different perspective, and we'll look at things for what they are. Things are not necessarily positive as I record this video, but they're not entirely negative either. So we want to weigh all of the evidence and then reach a conclusion about where we're at right now and where we're likely to go in the near future with the S&P 500. So let's go back and look at what happened this past week. We did have a flat open on the week. Way last Monday, we didn't have a big change from the previous Friday's close until Monday's open, which is kind of strange. When you have a weekend, when you have a lot of geopolitical events that are happening, it's really strange to have a pretty much flat open. Usually we gap up or we gap down. For the week, we did decline 1.44%. Now, if you watch things on a daily basis, it was a pretty wild ride just to finish not that much lower than where we started compared to what we went through during the week, because we are now range bound with prices. We've been dealing with a range for the last few weeks where we hit the upper end of the range, then we bounce down to the lower end of the range. After Friday's action, we're closer to the lower end of that range. When we look at volume for the past week, just on a weekly basis, we were above average overall. There were a couple of days where the daily average was below, but all in all, we did have above average volume. Now on Friday, there was options expiration for the monthly options and also the weekly options, being that it was the third Friday of the month. So that really boosts a lot of volume right there. And that may have given us some of the above average readings that we're seeing this week. What we're fixated on right now is on the daily charts and even a lot of the weekly charts. The technicals that I'm going to show you are negative. We've really seen things fall back from their all-time highs, but there's some positive things we can look at and some negative things that we need to respect. We are still kind of towards the latter part of earnings season. And the big thing in the markets these days is inflation. And when you talk about inflation, that also means interest rates. And there's a lot of geopolitical things going on right now. Specifically, what's really influencing the markets is the Russia-Ukraine situation. There's also a lot going on in Canada. The Olympics in China are wrapping up. There are talks going on in Austria about possibly letting Iran put some oil into the markets. And all of those things together are producing some concerns, with the number one concern right now being the Russia-Ukraine situation. When we look at the trend, we are seeing a strengthening trend. And this is going to look different than the daily chart, because now I'm switching over and looking at a weekly chart. And we are advancing as far as the trend is concerned, and that is negative. Some comments that we can say after Friday, February 18th, prices are back down within the short-term range that we've been in. On Friday, we also saw yields fall. Bonds went up, so yields went down. The Russia-Ukraine situation is dominating the news, as well as the crazy things going on in Canada. The economic reports overall gave kind of a mixed bag, but we did see some positive strength on Friday, which that could actually be negative. We're at the point now where too much economic strength is actually negative, because that might mean that interest rates get raised sooner and higher than what the market is comfortable with right now. On a longer term basis, we are overvalued. And then our trend is strengthening overall. Okay, so let's look at the intraday chart. And for those of you that don't watch my daily videos, each one of these bars right here is 10 minutes. And I go back a little over 5 days just to kind of keep a bit of context going. Well, right here on Monday, this is where we opened up, where I have my cursor circling. We initially saw some selling, where we're able to come back up. But then we saw some more late day selling, only to come back up. This is part of the roller coaster ride that we've been on. Tuesday, we actually saw a positive gap higher, but then prices pretty much drifted sideways for the rest of the session. Wednesday, we saw some initial selling, drifted sideways. This is when the FOMC meeting minutes came out. The market, at least that day, they liked what they read in that, so we saw some late day buying. But then as the situation between Russia and Ukraine gets a little more uncertain, we gapped lower at the open, saw some initial selling, did a little bit of a bounce, but then saw some real strong selling going into the close. And then on Friday, we kind of picked up where we left off on Thursday. There was not really a big gap. Tried to do some buying initially, but then dropped. But then something a little bit positive happened. We made it almost down to S2, which is the support level for that day. And then we saw some buying coming back in. Prices almost went back positive on Friday, but then sellers came in and we ended up closing at around the 43.56 level. Actually, it should be 43.48 level. I'm sorry, I'm looking at next week's pivot. So as far as sentiment, this is a report that I talk about every Thursday in my daily video. This is the American Association of Individual Investors. And every week they have a survey. I've taken this survey for years, and they try to figure out how are individual investors feeling. If they're positive or bullish on the market, this chart will go higher. If they're negative or bearish on the market, this will go down. Well, for the past week, we actually are seeing kind of an extreme negative reading. And because these folks tend to follow the crowd instead of necessarily use their information to make decisions before things end up happening, they tend to make a lot of bad decisions. And if you think about it, that makes sense. This is not to rag on them. Most of these people have jobs. They're professionals. They do things. They're tied up in their career. They have families. And so they also get a kick out of investing in the markets, but they can't really sit and watch it all the time. They can't really devote a whole room to computer monitors and news sources and looking at multiple charts at the same time. So they tend to just follow things, with a lot of them ending up making decisions over the weekend. And that's why I initially came out with this weekly video, was just to try to help those folks. But this could provide some support for the markets. When we get to an extreme reading, if you look up above, a lot of times, not necessarily right now, but when we have extreme bearishness, this has quite often marked some kind of a bottom in the market at that point. So, but this can last for a period of time. It doesn't mean that since we drifted in here right now that we're automatically going to bounce back up, but it just means that sentiment is bearish right now. Then we also look at a weekly chart of the VIX, and this is the fear gauge. As this gauge goes higher, that means there's more and more fear. As this comes down, that means that there is less fear. And I have just a closing basis chart on the top, a line chart where I have an open, high, low, close chart on the bottom. And we are still showing some pretty substantial fear overall. And this is advancing slightly. Doesn't mean that we can't, that we're going to turn and go up from here. because we can have more extreme readings. This is the COVID plunge right here. But we are seeing some real fear on a weekly basis right now. Also, one thing that I pointed out a while back in my daily videos, and I'm not bringing this up because anything's happening. I just want you to be aware of this. Not this past week, but the week before, we had the University of Michigan Sentiment Survey. Their preliminary report came out. They'll come out with their final report here pretty soon. But in this top part of this chart, you have, this is how people feel about things. If they're really happy, this green line goes up. If they're not very happy, the green line goes down. Down below, we have the 2-year yield. That's the interest rate on the 2-year. And what we notice is there's a pretty strong correlation between when the 2-year yield tops out and happiness seems to be at its peak. And then when both start to roll over, you also start to see interest rates fall at that point. The reason why I bring this up now is because we are very pessimistic. People are not happy with what's going on right now, but we're also seeing interest rates climbing. They're about in opposite direction, where they tend to go more hand in hand. So something might give at some point. Either people are going to have to get happy, or interest rates are going up too far too fast, and these and this won't happen overnight, but they need to get more in line with each other, since they tend to move with each other largely, not always, but largely. As far as our breadth on a weekly basis, we had a negative week. Based on price, based on volume, we had a decline for the weekly bar. Our long-term trend over a period of time, it's still positive, but is showing some weakness based on price, and we're ever so slightly crossing over negative based on volume. Looking at the advanced decline ratio on a weekly chart, we are negative overall. When the blue line is going down faster, that means we're going pretty quick. But when we have both the blue and the red line going down, that is negative overall. But it can have an extreme reading. Here, for a number of months, we were extreme positive as the market was going higher. New highs and new lows, we're seeing some internal weakness in the market, where here's the bar chart of what happened over the last few weeks. Overall, we saw more new lows than new highs for the week, so this indicator turned down. Then we use the accumulation distribution, kind of showing the same thing, where it's a little hard to see on this chart, where we're starting to show some potential weakness on a weekly basis. As far as our trend, this is an ADX. This is a weekly chart of the S&P 500 with the ADX plotted. We are in a strengthening trend, and when the red line is highest, that means that there's selling going on. So this is a negative trend where we see buying power decreasing. So it's picked up what it has seen over the last few weeks and saying that on a weekly basis, we are now in a negative trend, and that trend is strengthening. We're still just a little bit below 20, and that's usually the line that I draw on here. Some people use 25, some people use 24.962, whatever you want to use. I've always just stuck with 20 when it applies to the S&P 500. Another thing that we're watching on the daily charts is a thing called the mass index. When this goes above 27, that's signal number one, but then it starts to roll back over. And when it comes back down to 26.5, that's an official signal. And when that is generated, we then might see some kind of a significant move. We don't know if it's going to be up or down. If you look back over time, some of these signals were generated and we went up. Other signals were generated and we went down. We use other tools to determine what the direction might be, but this is just showing us that something might be happening, but we're still a while away. this past week on the daily chart, the signal was generated. However, it has not been generated yet on the weekly chart. Then I'll look at some longer term charts, and these usually cover months to years, where first of all, this is just a bar chart. The green bars are positive, the red bars are negative, and this is with the weekly pivot points plotted on here. And sometimes we can look at this and get some useful insight. Where we were moving up nicely, we set the all-time high, but ever since then, we've been trailing, and we're just below the weekly pivot right now. So that's slightly negative. Looking at our trend longer term on a weekly chart, yeah, the S&P 500 has been showing some weakness, but we're still slightly at or slightly above the longer term moving average, and I have a 50 period moving average plotted here. This blue moving average is a 13 period moving average. This is showing some weakness, but is overall positive. Then looking at a thing called the bullish percent index. This is a weekly chart of the stocks inside the S&P 500 that are giving us either a point and figure buy signal or a point and figure sell signal. For the past week, we dropped slightly below 50, so that's negative. When we're above 50 and going higher, that's positive. When we're below 50 and going lower, that's negative. Since we crossed right above the midpoint, that gives a negative signal. Another thing on a weekly chart is the Chaikin money flow. No, this isn't the Chaikin money flow. This is the Chaikin oscillator. Sorry, I'm getting things mixed up here. This is showing more of an extreme negative reading. And on the next chart, it'll be a little bit more pronounced. But this suggests that we, on a weekly basis, are in an oversold condition. Here's a longer term view of that same chart. If you go back and look, when we dropped below this pink line before, sometimes that signaled a bottom in the market. Now, we could fall even more, but there have been other times when we were at this level after the COVID plunge, we put in kind of a double bottom with this indicator before shooting higher. So this is suggesting on a weekly basis that we are oversold. And this is the Chaikin money flow, which is really mystifying me on the daily chart. We've been going down, but the CMF is going up. Here, it's a little more sane, where we've had a decline in prices. The CMF has been coming down on the weekly chart. The force index, when we're above and things are green, that is positive. When we're below and they're red, that is negative. With the declining bars that we see here, and we've seen over the last few weeks, this is more negative. Another thing is the McClellan oscillator. When it's above zero and advancing, that's positive. When it's below zero and declining, that is negative. So on a shorter term basis, the weekly trend is negative. And then that feeds into a thing called the summation index, which is also negative based on price and negative based on volume. Then there's a number of different momentum oscillators that I look at on a daily basis. I don't pay as much attention to them on the weekly charts, because if you see right here, here's slope. We had prices just going higher and higher and higher. Well, this produced what we would call a negative divergence. But why do we pay attention to that? We have a lot of other things that are suggesting during this time that things would go higher. A lot of this has to do with just how these indicators are calculated. So I look at them, but I don't get all hot and bothered if I go, ooh, we're seeing everything going up and this is trailing off. The MACD is trailing off. All of these are pretty much trailing off, because as the prices get higher and higher that are used in the calculation, it can't help but roll over. So it's not necessarily giving us a lot of good insight. Now, if you disagree with that, please let me know. But after watching these for 30 plus years in the markets, I've seen this over and over, and I don't want to get fooled by this or jump to a conclusion that I think I have confidence in when really it's not telling us what we think it might be telling us. Another thing is called the PMO, price momentum oscillator. This also has been rolling over for quite a while now, and somebody could say, oh, I saw that coming. Well, okay, but I don't really use it for that purpose. But if we look at things based on price and volume, we are negative on the weekly chart. We also have some studies, the PMO that are actually rising on a weekly basis, that is declining. Now that's important. And those that are providing buy signals, that's important. That's also declining. And those that are even positive, that is going slightly up to flat right now. Then RSI, because a lot of people use this. I'm not a big RSI fan, but I include these in my video updates because when I was learning technical analysis 25, 30 years ago, this was the first oscillator I ever learned about. And I teach classes on technical analysis, and this is the first oscillator that I teach people just because it is very popular. So I look at it. Well, we are below 50 with the RSI declining right now. So that is negative and not giving us an extreme reading on the weekly chart. We also have a thing called the special K that can be very helpful. This is still suggesting that we're in an uptrend, but that uptrend is showing signs of weakness. And on the daily chart, I show a longer chart. This is going back a number of years as it is, so we'll just leave it at that. Then we have a thing called Stochh RSI on our daily charts. These are very sensitive indicators. Even on the weekly charts, we've been buried down in oversold territory pretty much since the market has been falling. Then another thing is called the short-term oscillator developed by Carl Swinland. I switched this over to a weekly look, and we look at based on price and volume are negative because they're below zero and declining. And we still have more room to fall before these are giving us some kind of an extreme reading. Williams percent R is another sensitive indicator. It came down and gave an oversold reading only to bounce back up and is now declining without showing an extreme negative reading. Vortex, which I rely on heavily in the daily charts, this is negative because we see the red line above the green line and the red line is advancing with the green line declining. Then the ultimate oscillator, which I've never found all that much to have it be ultimate, but I still look at it because a lot of people do. We're below 50, that's negative, and this line is declining, which is also negative. But over the last few years, this has been an extreme negative reading, or at least close to it. Now, doesn't mean we can't go lower, but we just want to get some historical context here. Different charts, the Heiken Ashi, this is a weekly version of that chart where we have a down bar for the week. Here is a Kegi chart that is also negative because of the red line, or the drawing has switched to red. And then Renko, this is negative because of the red box. Then the equivolume, we had a net negative candle for the week, and we're declining on the ease of movement indicator, both the very short term based on 1 week and that then also based on 14 periods or 14 weeks. The point and figure chart is more negative. We had 3 circles drawn in this past week, but the longer term trend is still positive because the blue line is going up. 3 line break is also negative and has been negative for the past few weeks. As far as some different trading systems, this is the Elder system. When the bars are green, that's positive. When they're blue, that's neutral. When they're red, that's negative. Well, this picked up on the negativity pretty quick. We did try to come down to this moving average. It's a 65 period moving average. We bounced up off of that, but now we're coming back down again. The SAR, stop and reverse. This has been negative for about the last month or so. After we hit that all-time high, it's been having a little bit of trouble. As far as some other things that we look at in the broad market, the S&P, this is a weekly chart here. Here's a weekly chart of the mid caps where we've been treading sideways for the last year or so. Here's small caps, which on a weekly chart, we've also been going sideways. This is an all stock index. You take them all together and you come up with an index. I usually go over the daily version. This is the weekly version where we are dropping down below the moving averages. The blue moving average, which is a 13-period moving average, that's what I use on the weekly charts. And because there are 52 weeks in a year, I use 50 as a moving average. Well, we're seeing the 13 coming down to the 50. Then the mid caps have been pretty much treading sideways on the weekly chart. And they're doing that for the last few weeks on the daily chart as well. Same thing with the small caps, although we're in the lower part of this range. And this is part of the negative divergence that we're seeing. In a good, healthy environment, you want to see small caps doing very well. You also want to see mid caps doing well. They're considered to be more risky. When people start to get a little bit nervous, they get out of their riskier stocks and tend to get into more defensive stocks or better named stocks, those that have been around. Here's the Dow. It is also negative. We have dropped below the 50-period moving average with the blue line rolling over. So it's going to need to do some work if the Dow wants to get back more positive on the weekly charts. Here's the NASDAQ, also been having a lot of trouble lately. NASDAQ 100, pretty much the same thing. Below both moving averages, and for the last month or so has been having some trouble. NYSE holding up a little better, but overall on a weekly basis, it's been going sideways. And the Wilshire, more broad measure index, but it's been having some trouble and the moving averages are in danger of crossing over. Then we look at the FANG stocks. These are the big tech stocks: Facebook, Alphabet, which is Google, Netflix, Amazon, whatever the big stocks are. These are the big tech names. Well, the weekly chart, it is rolling over and we are at a death cross right now. ARK, which is a very popular ETF run by Cathie Wood, well, not as popular as she has been in the past. She had a really good start to 2021, but has really suffered ever since then and has gone down almost 10% on the week. Other broad market areas that I cover, this is the CRB. This measures commodities. On the daily chart, we have a really strong uptrend. Well, we're seeing that same thing on the weekly chart. Gold, this, and I believe, yes, no, I don't have a longer term view here. Everybody keeps thinking that stocks are going in the toilet and gold is going to the moon. That may very well happen because there is real value attached to gold, where there's more intrinsic value on some of these other things. We might be seeing a breakout, but there is some resistance, and we've been at these prices before. So we'll watch this very closely, but it doesn't necessarily mean we're breaking out. It just means that we've been consolidating for a long period of time. However, the longer things consolidate, the more powerful the move tends to be, either up or down. Here's oil, which has just been screaming. Just think, in April 2020, look at where oil was. Wouldn't you like to fill your car at that price? Well, we've been screaming up. We got above 95 this week and ended up closing right at a little bit above 90. And you're really feeling that every time you fill up. As far as some relative studies to go over, this is stocks versus bonds. This is a monthly chart, but I like to look at this on a weekly basis. This just says that over the last, well, this goes back to where it really picks up is in the late 80s right here. But this is just rating. Would you have done better with stocks or with bonds? And these are a couple of mutual funds that you could get into, a stock fund or a bond fund. and stocks have greatly outperformed bonds, especially since the whole COVID plunge, but it could be showing some signs of weakness as interest rates are going higher. Another thing to watch that I've been watching is the gold relationship to the dollar. The dollar's been holding up, but with inflation at what it is, you're already getting hit at 7.5% inflation. At least that's what they're telling us. In real terms, it's probably 15, 16, 17% inflation. Well, a lot of people, when they're fearful of inflation, get into gold. And this is a long-term chart. I just drew a trend line over here at some peaks that we hit before. And then this is more of a shorter term peak going back to 2020. And what we want to watch for to see is if gold is really taking over and really breaking out in relation to the dollar, we want to see it first break above this red line and then eventually break above the blue line. Then looking at the growth stocks compared to the value stocks, and this is a weekly chart going back a long way. Well, for the most part, after we had the whole meltdown, growth did very well. There are periods of time when value comes in and does well. Well, that's the battle that the market is raging right now. Do we get into growth stocks that tend to do better in downward markets, or do we get into growth stocks that tend to do better in bull markets? And it's almost a daily basis going back and forth right now. But overall, value has been doing better, which means growth has been suffering. There's another index, the growth index, and then I take a ratio of this. I divide it by the value index. This is pretty much showing the same thing. We're seeing a real decline in growth, which if you flip this chart around, that means there's a real increase in value. Then the NASDAQ 100, which is heavily laden with tech stocks against the S&P 500, we're seeing the NASDAQ 100 really underperforming the S&P 500 right now. And then the S&P 100, which are the biggest stocks in the S&P against the S&P 500 itself, didn't really move all that much for the week, but it's been chopping around. If we want to really take things higher, we're going to have to see leadership from the really big stocks. And that's what the market is trying to figure out right now. So our conclusion, what I've concluded and what I'm saying in my daily videos, that the long-term bias remains positive, but we're showing overall weakness. And this should be conclusion for the week of February 22nd through the 25th. This is my first time doing a weekly video in quite a while, so things are a little bit unorganized, and it took me a long time just to put together what I presented. So we are cautiously optimistic, but we have to be realistic at the same time because a lot of our charts are negative right now. So thank you very much for watching this video. Here's some information if you want to contact me. I hope you have a wonderful week, and please feel free to check out the daily videos, and I will talk to you next time.